definitely been one of the more challenging ones in terms of earnings performance across the board. We've definitely had a few doozies in there. So, of the 40 odd results, there have been very few earnings upgrades, plenty of earnings downgrades, and lots of cautious outlook statements. But it's really been that guidance that's probably disappointed and seen some share prices come down a little bit. Remember, these results are for the year to 30 June, so they are a little bit backward looking. And if you think about the first half of this calendar year through to June, the economy hasn't felt that strong. So that's kind of what's being reflected in some of these corporate results. Many companies are talking about demand still falling and costs still rising. That's a pretty tough backdrop for corporates to be performing well in. And then I guess there is that expectation that interest rates are going to fall further. We've already seen one cut earlier in August. We expect a couple more before the end of the year. But I guess the key point is the rubber won't really hit the road in terms of those interest rate cuts until next year, when consumers start to feel that in their own pocket and you see the economy start to rise a little bit. So we've got a little bit of time to wait in this almost no man's land where the economy is still tough, but we know things are going to improve as we head into the back part of this year and into early 2025. Yeah, so a handful of good results. Fisher & Paykel was probably the standout. That company came out. It didn't actually have a result. It just gave guidance for a result that's coming in a couple of months. But essentially, the guidance was about 10% ahead of market expectations. So you saw a strong share price reaction on that. And actually, the stock is up 50% so far this year, which is pretty phenomenal given the size of that company. The other good results were Chorus, and while the result was in line with expectation, the surprise which saw the share price jump about 10% was they've guided to their dividend profile over the next few years being much higher than the market was expecting. And then I guess the last one to mention is probably Scales, our largest apple producer. They had a first half result which was in line with expectations, so steady as she goes, but the horticulture business, which has had a tough couple of years with cyclones and other issues, came back to life this year. So I think the stock moved up about 5%, and it was a little bit of a relief rally. The stock has been under pressure over the last 18 months or so. So I think a good, solid result was good news and taken positively by the market. Yeah, this was a bit of a funny one because there were worse performers in terms of share price for different reasons. So I'll start with A2 Milk, which fell about 20% following its result in the time. It wasn't a bad result. In fact, it was in line with expectations. They still expect to grow next year and grow pretty well, but that growth next year is short of what the market was expecting. And the stock had run up so much this year that there was a lot built into those expectations. It didn't quite hit the mark, so we saw the shares come back a little bit. Still one of our best performers so far this year. It just ran out of legs a little bit as the result hit the market. The other ones, I guess the big disappointing one was probably Spark. Now, its result for the full year missed guidance by a very small amount, but that's enough when it's a company that's meant to be stable and reliable and defensive to spook the market. And the other big issue that Spark has got at the moment that the market is grappling with is, they've got a dividend that's reasonably high and attractive, but they've got some growth that they need to fund as well, particularly in data centers. And underpinning all of that is a balance sheet that looks a little bit stretched at the moment. So the market's not sure how it's going to manage that tightrope between growth and paying dividends to shareholders, particularly at a time when they're not generating a huge amount of cash flow. So that one was under pressure. And then I guess the third one to mention, and I feel like every time we do these videos, it's the one that comes up as one of the underperformers. Poor old Fletcher Building had another disappointing result. It was in line with expectations, but still down 35% on last year. So the big news, I guess, was the outlook statement. They still expect volumes to fall again. So volumes in the last 12 months fell 25%. They expect another 10 to 15% fall. So that indicated to the market that there's not really light at the end of the tunnel in terms of a turnaround. And then there's been a lot going on since then in terms of litigation risks and so forth. And as I filmed this video today, actually the stock is in a trading halt. So plenty of uncertainty there and plenty of disappointment, unfortunately. Yeah, it's been, again, a mixed bag, like I said at the start, some good sectors, some bad sectors. The four that I'll call out is probably the first one, retirement village operators, and they've been a little bit unloved over the last, call it a couple of years for different reasons. The housing market is finally starting to stabilise, and there is some positive, outlook out there with interest rates falling, but operationally things are still pretty tough for most of them. Yeah, I guess the boost that the sector has got is from Arvida being potentially taken over. That feels like it's almost a foregone conclusion now. We're at the final sort of hurdles for that, but that's highlighted the latent value. So Arvida was the takeover offer is about 65% higher than where the shares were trading. So it sort of, I guess, gave the sector a boost and reminded people that there is a lot of value sitting there, and someone is willing to come along and pay some big bucks for these businesses. So it's performed a little bit better in terms of share prices, but the operational environment is still, not out of the woods yet in terms of the housing market and general sort of construction. And talking about construction, I guess that's been another one worth highlighting. I talked about Fletcher Building, but Steel and Tube, Vulcan Steel, lots of businesses in that sector. And I guess the key theme is that volumes are down across most of those players. Consents continue to fall, so it's a tough backdrop. It's a cyclical sector, and the cycle doesn't feel like it's turning positive quite just yet. So don't expect any reprieve, at least in the short term. But again, as we head into 2025, we can see an environment where things start to improve from where they are today. Another sector that's been down in the doldrums is retail. You think about the Warehouse, Kathmandu, Michael Hill. There's been a plethora of disappointing announcements out from all of those companies. Saying that there's some green shoots emerging would be probably a little bit too optimistic, but we have certainly seen some less bad announcements from some of those companies. So maybe we're at the end of the really bad cycle for those retailers. And again, you cut interest rates, put more money in consumers' pockets, they will go out and spend that, and retail generally, is a beneficiary of that first and foremost. And then finally, the last sector worth mentioning is electricity. It is our biggest single sector, and geez, it's been in the spotlight a lot lately. Usually a pretty stable and reliable sector in terms of earnings, but at the moment we've got a very dry winter, and remember, about 60% of our electricity generation comes from hydro, so that's been under pressure. Typically when that happens, we turn to gas, but there's not been gas availability, so what you've seen is the price of electricity spike, and you've seen that in some industrial customers feeling the pinch. And I think, look, they're going to stay in the spotlight. It's definitely a sector that has some uncertainty in the short term. And when I say short term, I mean next 6 to 12 to 18 months. But look at the longer term picture. We still want to move to more renewable. We want to get away from burning fossil fuels. We've got a commitment to be net carbon zero by 2050. All of those things bode well for the sector, but in the short term, there are some of those risks around just purely having the fuel, and that fuel being rainfall and water at the moment. But longer term, it's still a stable and attractive sector to be a part of, I think. Yeah, like I mentioned at the start, the outlook statements have been cautious, which some would be surprised. We've got a Reserve Bank that's cutting interest rates. So, why are we still cautious in terms of corporates? Well, like I mentioned, that rubber hasn't hit the road. The feel-good factor is there in terms of expectations that we'll have more money in our pockets, but that's going to take a while to come. It's a slow boat to turn. So that environment will change, but it will take a little bit of time. But what the CEOs of these companies are seeing right here, right now, is still demand being a little bit flat and down for some sectors. Costs are still rising, whether it's shipping costs, whether it's supply chain, whether it's labor, rent, insurance. Those things haven't all of a sudden fallen back to zero in terms of price rises. So there is still a tough 6 months to navigate for our corporates, I think. The AGM season, which is a couple of weeks away, that will probably be when we get a better picture of how things are going. So companies will have had 3 or 4 months of this current financial year, which starts on 1 July, having gone through. So they'll be able to send a clearer picture to us of how things are tracking, and they'll probably give, for many of them, their first set of guidance for the financial year 2025. So that will be where the rubber hits the road, and we'll be able to get a sense of if the market is too optimistic or too conservative versus what's actually going on in real world
And our
news
summary
here.
would be that, we are either at the bottom or the worst part of this earnings cycle, and for some sectors, we're actually past the worst of it. And if you look ahead, the positives are that interest rates are going to keep coming down, and not only domestically but globally as well, which will help our export sectors, flourish. So we can see an environment which paves the way for a much stronger 2025 for corporates, but there is a little bit of hard work still to go in the next few months until we start reaping the benefits of an economic backdrop that is stronger than it has been for probably the last 18 months.
For more insights, visit craigsip.com.